So on January 30th, 2026, SM Energy officially closed this absolute monster of a deal.
Right. The multi-billion-dollar merger with Civitas.
Exactly. And instantly, they transform into this scaled four-basin operator. Now, if you look at the track record of massive E&P acquisitions, I mean, you know how it goes.
Oh, yeah. The first 90 days are usually just brutal.
Right. You expect integration friction, capital inefficiencies, delayed well turn-in lines, just chaos. But we are doing a deep dive today into their official 10Q SEC filing and their Q1 earnings presentation from May 2026.
And what we found is, well, it's honestly a massive structural paradox.
It really is. I want to welcome everyone joining us on this deep dive. Today, our mission is to look under the hood and decode the anatomy of this specific integration. Because frankly, you do not need to be a petroleum engineer or a Wall Street banker to be fascinated by this.
No, you really don't, because the financials here represent a complete divergence between their underlying cash flow velocity and their headline accounting.
Yeah, they absolutely crushed all their operational targets. I mean, across the Permian, the DJ, the Uinta, and South Texas basins, they upgraded their debt profile significantly.
And yet, somehow, they printed a $355 million net loss for the quarter.
Which is exactly why we need to unpack this. It's a masterclass in how a company can completely rewire its cost structure in real time while apparently losing $250 million on paper.
Yeah, and the physical output is really where this whole thesis has to start, because financial engineering only works if the rock is actually delivering, right?
The oil has to flow.
Exactly. Moving from a mid-cap operator to this massive four-basin footprint, it changes the fundamental physics of how you deploy your capital.
Okay, let's unpack this. Because the production numbers in Q1 2026, they just blew past the high end of their own guidance.
They really did.
The midpoint target was 350,000 barrels of oil equivalent per day, but they actually hit 371.2. And oil alone was at 190.3 thousand barrels a day.
Which is a huge beat.
Yeah. I mean, when an operator beats their target by over 20,000 barrels a day in the very first quarter post-merger, my immediate reaction is just total skepticism.
Sure, you assume they're playing games.
Right. Are they just, sandbagging their initial guidance so they can secure an easy win with the analysts? Or are they high-grading their drilling schedule and pulling all their Tier 1 inventory forward just to look good?
Well, what's fascinating here is that the capital expenditure data completely disproves that sandbagging theory.
Really? How so?
Think about it. If they were simply brute forcing their way to a production beat-like by accelerating their drilling schedule, you would see a corresponding blowout in CapEx.
Right, you'd have to spend more money to get that oil out faster.
Exactly. But instead, they budgeted a midpoint of $760 million for capital expenditures, and they only spent $672 million.
Wait, so they spent $88 million less than they planned, but got 20,000 more barrels a day.
Yeah, an $88 million CapEx underrun while over-delivering on production.
It's like throwing this massive, ridiculously expensive wedding and somehow finishing the night with leftover cake and a smaller catering bill than you even budgeted for.
That is a perfect analogy, and you don't get that combination by accident.
No, you really don't. And I know the filings mention some infrastructure deferrals, but that can't account for all of it.
It doesn't. The infrastructure deferrals pushed to Q2, those are just a minor footnote compared to the actual capital efficiency gains they're seeing.
So it's the scale that's doing it.
Yes. When you increase your scale to this degree, your per-foot drilling metrics and your completion cycle times, they just compress rapidly.
Meaning they're drilling faster and cheaper.
Right. They're keeping the drill bit turning to the right with far less non-productive time. So the capital they deploy is converting to flowing hydrocarbons way faster than they modeled.
Wow. Okay, so let's shift to how they are actually changing that cost structure, because the filings detail this massive jump in their synergy targets.
The synergies are wild.
Yeah, so the original promise when the Civitas deal was announced was $200 million in synergies. But now, in the Q1 report, they've nearly doubled that.
To a $375 million run rate.
Right, and they claim they've already actioned $300 million of it. The NPV 10, the net present value of those synergies, is projected at $1.8 billion.
And that $1.8 billion figure, that tells you this isn't just a temporary bump. They are structurally lowering the long-term break-even price of their entire inventory.
See, I always look at that word synergies with a healthy dose of cynicism.
Oh, absolutely. It's a loaded term.
Right, because in a lot of corporate M&A, claiming a huge synergy run rate is just a polite Wall Street way of saying you gutted middle management and closed some redundant offices.
Just firing people, essentially.
Yeah, exactly. Now, the filings break this down into three buckets. There's $75 million in interest savings, $100 million in overhead and G&A, and then a massive $200 million in drilling, completion, and operations.
Right, the D&C bucket.
So, I buy the $100 million in G&A headcount reduction. But finding $200 million strictly in operational efficiency within the first 90 days, is that actual margin expansion in the dirt, or is it just creative accounting?
No, the margin expansion in the dirt is very real. It's specifically driven by program-level optimization in the Permian Basin.
Okay, break that down for me.
Sure, when you combine the SM and Civitas acreage, you aren't just adding discrete little drilling blocks together, you are creating these massive contiguous swaths of land.
Which I imagine fundamentally changes the logistics of everything.
Completely. Think about the mobilization costs of a modern drilling rig or a massive pressure pumping fleet.
Just getting it there is expensive.
Tearing it down, moving it, rigging it back up. It's pure non-productive time. But with larger contiguous acreage, you can design pad development programs that minimize rig moves.
So you just drill longer continuous programs. You set up once and stay there.
Exactly. And beyond that, your purchasing power with the major oil field service providers fundamentally shifts.
Because you're a bigger client now?
Right. You aren't negotiating for spot market frac crews anymore. You are locking in dedicated fleets at significant discounts.
Because you can guarantee them a solid year of uninterrupted work.
Exactly.
Yeah.
And the filings also highlight localized infrastructure sharing, particularly around fluid management.
Like produced water disposal.
Yes. Produced water disposal is one of the heaviest ongoing lease operating expenses in the Permian.
So if you merge two adjacent footprints, you suddenly have the ability to route that produced water via pipeline, right?
Right, directly to a much wider network of company-owned saltwater disposal wells.
Instead of paying exorbitant rates to truck it around or send it to third-party commercial disposals.
That disposal routing alone strips millions of dollars out of their recurring expenses. So that $200 million operational synergy bucket. It is a direct reflection of bulk purchasing power and optimized fluid logistics acting as a deflationary force on their well costs.
Wow. Okay, here's where it gets really interesting. Because if the underlying operational engine is humming like this, if they are crushing production targets, underrunning CapEx, and actioning $300 million in structural cost savings, you would expect a massive net income print.
You'd expect them to be swimming in cash on paper.
Right. But you open the 10Q, and the headline is a GAAP net loss of $335 million.
Which is a tough number to look at.
Especially for context, because they posted $182 million net income in Q1 of the previous year.
Yeah, that's a huge swing.
To the casual observer, dropping $1/3 billion in your first quarter as a combined entity, it looks like an absolute disaster. Like it's like buying a house. On the day you close, your bank account looks entirely empty because of closing costs, escrow, and fees, but your overall net worth and asset base are perfectly fine.
That's a great way to think about it. And this raises an important question about the utility of GAAP accounting in the immediate aftermath of a highly levered transaction like this.
Because GAAP doesn't tell the whole story.
It really doesn't. The GAAP net loss in this quarter is almost entirely a mathematical artifact of their hedging book and the one-time friction costs of the deal itself.
Okay, well, the friction costs are straightforward. The filings show $135 million in one-time transaction and integration expenses.
Right. You have to pay the investment bankers, the legal teams, you pay out the severance packages, and you integrate the enterprise software.
It's a heavy cash drag, but it doesn't repeat next quarter.
Exactly. It's a one and done.
But the real anchor on that GAAP number is the $697 million net derivative loss. Explain that to me.
So the mark-to-market mechanics on their hedge book completely distorted the income statement.
Okay, how?
When SM Energy underwrote the Civitas acquisition, they utilized debt, and lenders in the energy sector mandate structural downside protection.
They want to guarantee they'll get paid back.
Right. They demand certainty that the asset base will generate enough cash flow to service that debt, even if WTI crude drops to, say, $50 a barrel.
So SM Energy aggressively hedged their oil.
They did. They have roughly 54% of their expected oil production for the rest of 2026 locked in.
And the strikes are sitting between $61.16 up to $65.18 per barrel.
Yeah. And when the forward curve for crude oil moves aggressively above that 61 to 65 band, which is exactly what we saw in Q1, the market value of those financial derivatives plummets.
Because the market price is higher than what they locked in.
Exactly. And GAAP accounting requires them to record that loss in value on the income statement immediately.
Wait, so that's $697 million loss. That isn't actual cash going out the door.
Not at all. It is an unrealized, non-cash paper loss. It purely reflects the opportunity cost of not selling those specific hedged barrels at the higher spot price.
Oh, wow. Meanwhile, the other 46% of their unhedged production is out there capturing that higher spot price in the physical market, generating massive cash flow.
Exactly. This is why looking at GAAP net income during a rising price environment for a heavily hedged operator is virtually useless.
You have to look at adjusted EBITDAX.
Yes. Adjusted EBITDAX strips out the unrealized derivative noise and those one-time transaction fees.
And for Q1 2026, SM Energy reported $970 million in adjusted EBITDAX.
Almost $1 billion.
That is the actual cash generation engine of the business. Nearly $1 billion in pure operating cash flow in a single quarter, which gives them immense flexibility to clean up the balance sheet.
Because absorbing a multi-billion-dollar entity requires taking on a massive debt load.
Right, and the subsequent mandate is ruthless deleveraging. You have to prune the non-core assets to feed the core machine.
And the speed of their divestiture program has been just staggering. They announced a post-merger target of over $1 billion in divestitures.
And by April 30th, they had already closed a $950 million sale of their assets in the Maverick Basin of South Texas.
Yeah, that almost gets them to the finish line right there.
Selling off South Texas is a really fascinating strategic move. I mean, the Maverick Basin assets are solid cash-flowing properties.
They are good assets, yeah.
But in a scaled four-basin portfolio, capital allocation becomes hyper-competitive. Every dollar of drilling capital has to fight for its place in the budget.
Exactly.
So why hold on to an asset that requires constant capital maintenance if the returns on that capital are vastly superior over in the Permian or the Uinta?
If we connect this to the bigger picture, this is the textbook definition of portfolio high grading.
High grading, right.
Yeah. When SM absorbed Civitas, the sheer volume of Tier 1 inventory they acquired meant the South Texas assets immediately fell to the bottom of the capital queue.
They just weren't the shiny new toy anymore.
Right. And rather than starving those assets of capital and just letting their production decline, they monetized them in a strong market.
Smart. They extracted $950 million in liquidity and immediately deployed it to restructure their capital stack. And the mechanics of that debt restructuring are super aggressive.
Very aggressive.
They didn't just pay down some revolving credit facility. They targeted the absolute most toxic paper on their balance sheet.
Yeah, they retired $784 million of high-coupon debt that was carrying an 8.375% interest rate.
That is a brutal rate.
It is. But at the same time, they executed a $1 billion senior notes, offering it a highly favorable 6.625% rate.
And they pushed the maturity profile all the way out from 2028 out to 2034.
The interest expense arbitrage there is massive. You strip out near-term maturity risk, lower your blended cost of capital, and lock in a long runway of financial flexibility.
And because of the South Texas divestment and the resulting debt swaps, their leverage metrics are just plummeting.
They are mapping a clear trajectory to low 1x leverage by year-end 2026.
Meaning their total outstanding debt will be roughly equal to just a single year of cash earnings.
Which is incredible for a company that just did a massive merger.
Right. And that kind of balance sheet fortification in a post-M&A environment triggers immediate reactions from the credit markets.
Oh, absolutely.
The filings highlight that S&P, Fitch, and Moody's have all issued upgrades or positive outlooks. They are actively forcing their way into an investment grade rating, which just lowers their cost of capital even further.
It is a compounding loop of financial efficiency. But again, we have to remember that financial efficiency is entirely predicated on the technical execution out in the basins.
Right, the actual drilling.
Yeah, you can restructure notes out to 2034 all you want, but if your type curves degrade or your completion costs blow out, the leverage ratio spikes right back up.
Which forces us down into the trenches. We really need to look at the basin-level engineering detailed in this presentation.
Because they actually raised their 2026 production outlook.
They did, to a range of 410 to 430,000 barrels of oil equivalent per day. You don't raise full-year guidance in Q1 unless you are seeing a systemic shift in well performance and completion efficiency.
Let's start with the Uinta Basin, because the margins they are pulling out of Utah are staggering.
They are generating approximately $40 per barrel equivalent in pure cash margin.
And the primary driver seems to be the deployment of massive 4-mile lateral wells.
So what does this all mean? Like a 4-mile well? It sounds like trying to drink 2 thick milkshakes at the exact same time using a straw that is 4 miles long. How is that physically and economically possible?
Well, the 4-mile lateral is rapidly becoming the frontier of capital efficiency in shale. Historically, a standard horizontal well might run for 10,000 feet.
Roughly 2 miles.
Right. But SM Energy is engineering well bores that turn horizontal and push through the rock for 21,000 feet or more.
But the deeper you drill, the more friction and torque you encounter.
Oh, yeah. The engineering tolerances required to maintain a drill bit, steer it accurately through a specific pay zone, and manage fluid pressures at the end of a 4-mile string of steel are immense.
So why take on that level of operational risk? It sounds like a nightmare.
It comes down to amortizing the vertical sunk costs.
You have to dig straight down before you turn sideways.
Exactly. Drilling down to the target depth, setting the initial casing, cementing it in place. That is an incredibly expensive non-producing fixed cost.
Right, because there's no oil there yet.
So if you drill a 2-mile lateral, you divide that massive vertical cost by 2 miles of producing rock. But if you push that lateral out to 4 miles, you are exposing double the amount of hydrocarbon-bearing rock to the wellbore, while only paying for that vertical casing string once.
Oh, that makes perfect sense.
Yeah, and SM Energy's filings explicitly note that these 4-mile designs in the Uinta are delivering a 10% or greater savings in drilling costs per foot compared to the legacy 2-mile program.
Which fundamentally lowers the break-even economics of the entire basin.
Exactly, the dynamic.
And while Uinta is pushing the limits of drilling length, the DJ Basin is completely rewriting completion speed. The presentation highlights a 25% year-over-year jump in completion efficiency in the DJ.
A 25% leap in operational speed in a mature, industrialized basin is almost unheard of.
Right. And the filings attribute this entirely to a transition away from traditional zipper fracs and fully adopting simul-frac operations.
The shift to simul-fracs is arguably the most impactful completion technology in the field today.
Explain the difference for us between a zipper frac and a simul-frac.
Sure. So to appreciate the efficiency gain, you have to look at the mechanics of a legacy zipper frac. In a zipper operation, you have 2 adjacent wells on a pad.
Well A and well B.
Right. You pump high-pressure fluid and sand into well A. When that stage is done, you shut down the pumps, let the pressure bleed off, swap all the surface valves over to well B, and bring the pumps back online.
So it's strictly sequential. You are constantly dealing with idle horsepower.
Yes. Half of your massive, incredibly expensive pressure pumping fleet is essentially sitting in neutral while wireline crews move equipment and valves are thrown.
I imagine the non-productive time is staggering when you calculate it over a 50-stage well?
It really adds up, but a simul-frac eliminates that entirely. Instead of alternating, you deploy an absolutely massive concentration of pumping horsepower on the surface, and you stimulate well A and well B simultaneously.
That is wild. I think of it like upgrading a congested single-lane highway to a massive multi-lane tollway for fluid and pressure.
That's pretty much exactly what it is.
But you are maintaining constant extreme pressure down 2 separate wellbores at the exact same time. The logistics of delivering enough sand and water to the pad to keep a simul-frac running without starving the pumps, that must be an absolute nightmare.
It is. The surface logistics are highly complex, requiring continuous, localized sand delivery and massive fluid staging. But the payoff is worth it.
Because you get a 25% reduction in days spent on location.
Exactly. You're paying the exorbitant daily rate of a frac crew for significantly fewer days.
And you are bringing that oil to market and generating cash weeks earlier than a sequential zipper frac allows.
Which is huge for the bottom line.
Yeah. And when you layer that DJ Basin completion speed and the Uinta 4-mile drilling efficiency on top of the Permian Basin, which, by the way, they noted just delivered the longest and fastest Wolfcamp D wells in company history, the strategic rationale for the Civitas acquisition just becomes undeniable.
It really creates a self-reinforcing operational model.
A flywheel.
Yes, exactly. Scale dictates leverage over the supply chain, which then enables the deployment of hyper-efficient technologies like simul-fracs.
which lowers the cost per
It
foot.
widens the cash margin.
Which brings us back to that flywheel effect. I mean,
Mm.
you look at this Q1 2026 report, and you see a company operating at peak financial velocity.
Absolutely.
The operational efficiency generates that $970 million in adjusted EBITDAX. They take that cash flow, combine it with the $950 million Maverick Basin divestment, and aggressively assault their high-interest debt, saving $75 million in interest payments.
Right, and that deleveraging locks them into an investment-grade trajectory.
Lowering their future cost of capital and ultimately maximizing the free cash flow available for shareholder returns. I mean, they essentially digested a massive competitor, completely re-engineered their balance sheet, and improved their basin-level execution all within 90 days.
It's impressive. It completely validates the macro thesis of the current M&A wave in the industry.
That consolidation isn't just about accumulating more acreage to drill.
Exactly. It is about reaching a critical mass where industrial efficiencies override cyclical price volatility.
But, looking at how brutally efficient SM Energy has become just 3 months post-merger, it forces you to think about the macroeconomic endgame here.
What do you mean?
Well, if combining two mid-size operators unlocks nearly $400 million in structural synergies, enables these crazy 4-mile laterals, and generates nearly $1 billion in operational cash flow in a single quarter, what is the absolute physical and economic limit of shale consolidation?
Well, that is the big question.
Right? Are we rapidly accelerating toward a future where the entire U.S. energy grid is controlled by just 2 or 3 hyper-scaled megacorporations?
It's definitely a possibility.
A scenario where the Permian Basin isn't really an oil field anymore, but a fully automated, aggressively optimized manufacturing floor. Running simul-fracs and AI-driven fluid logistics with zero operational waste.
Just a hyper-efficient factory.
Exactly. If 90 days of scale can achieve this level of financial and physical engineering, the ultimate endpoint of this consolidation wave might fundamentally rewrite global energy economics.
It's a fascinating thought experiment.
It really is. Something for all of you to think about as you watch these mega mergers continue to unfold. Thanks for joining us on this deep dive, and we'll catch you next time.